Welcome back to All Things Money. I'm David Blain, and during today's show, we're covering our 2011 outlook. We're currently in the sector and industry part of our outlook, where we discuss specific sectors of the economy, specific industries that we think will do best over different parts of 2011. In case you missed the first two segments, we expect the first part of 2011 to be a continuation of 2010, meaning that a broad-based rise in global markets, fairly positive for investing in stocks. We do expect that somewhere in 2011 for this trend to change, that based on the economics, some valuation, PE ratios, rising interest rates, inflation, a number of factors that some point in 2011 we would expect the stock markets to enter another bear market phase. So we're talking about two phases here. In the first phase, we're currently overweighting information technology, materials, and energy, and those are a continuation of our commodity and infrastructure themes of, as we come out of the global recession, countries and companies investing in commodities, the demand for things that come out of the ground, as well as building infrastructure, the technology, industrials, things like that. This has been a theme that we have been emphasizing for several years right now. We think that this will continue at least through the first part of the year. Once the second half of the year comes and the market takes a potential downturn, we would reevaluate these positions. And as I said in the first and second segment, we like to give this outlook at the beginning of the year. Everybody does it in the investment and economic industry. It's sort of a time-honored tradition that everyone does. But most importantly, keep in mind that what's going to drive returns in 2011 is not what we know already. It's going to be how investors react to some unanticipated events. And so what we're trying to do is give an expectational outlook, so when things start to diverge from what we expect, you will know that something has changed in the economy and you may need to take a look at your investment allocation. So let's take a look at the commodity sectors. Commodities are on fire as we ended 2010. They're moving higher, oil, grains, your energy commodities, metals, mining, coal, all these type of things that are dug out of the ground and people need to make other things were definitely rising. We expect this commodity theme to continue over the next, say 6 months or so, but come the middle of the year, we'd be very cautious. China is a big consumer of these raw materials. Their economy, they have inflation problems, and they're already taking steps to try to rein in that inflation. And their market, in fact, in 2010 really took a breather. So we would keep an eye on China. If their demand continues to wane slightly, we would be cautious about the commodities. But for now, we're emphasizing coal, oil exploration and production, as well as equipment and services, metals and mining, steel, paper and forest products, and those type of things. In the consumer sector, contrary to what the majority of the pundits thought, this is a great example of what people felt was going to happen, but you've got to pay attention to what is happening. Consumer discretionary, the retail industry, was one of the best performing sectors in the year 2010. And all you read about in the paper is how the consumer is not spending any money, and sales are down and this and that. Well, it's that, but the companies in the retail industry were able to grow their profits at a tremendous rate last year. Automobiles rebounded significantly, and we think that sector, that theme is largely played out, though, and we would not necessarily emphasize that for 2011 if you're looking for the big gains. We think that a lot of the retail Now people are realizing that 2010 wasn't so bad for retail, and so it's not one that we're emphasizing. In terms of technology, we are emphasizing technology right now, especially your semiconductors, networking equipment, computer hardware, the infrastructure, the products and services that are building the infrastructure. The companies around the world are investing in infrastructure to build up their capacity again after the recession. We look at the business spending versus consumer spending as an indicator of this infrastructure building, and the businesses are continuing to outspend the consumer. Earnings growth in the technology arena has been very good. As we approach the bull market peak in 2011, you need to be cautious of some of these sectors as the market peaks, as the economy peaks. These infrastructure sectors, semiconductors and things like that will be the ones that probably get the hardest hit. Okay, so that's taken us almost to the end of our show today. I'm taking 2 full shows to cover our outlook for the stock market. Next week we'll pick up again with the economy, fixed income, as well as a little bit more on commodities and currencies. But we're going to take the last minute here and just kind of wrap up. So on the global stock market, we would expect a sort of a dual phase market for next year, the global uptrend to continue through the first half of the year with emerging markets, especially away from the big markets of China and Brazil. Look at some of the other emerging markets to outperform. Second half of the year, we would look for broad-based weakness, emphasizing small caps, growth companies at the beginning of the year. The second half of the year or after the bull market peak, we would take a look at large companies. We would take a look at dividend payers after the bull market peak when the economy and the markets begin to slow. As far as sectors, we're currently overweight technology, materials, and energy. The second half after the bull market peak, we would take a look at more things like utility, consumer staples. We like coals, metals, mining, things like that today, as well as semiconductors and hardware equipment. After the cyclical peak, we would take a look at things like food, tobacco, and services. Well, that's about all the time we have for today. Hope you'll join us next week where we'll talk a little bit about the economy for 2011. For All Things Money, I'm David Blain.